Hey there. So let me tell you this, required minimum distributions can feel confusing sometimes, but they don't really have to derail your retirement. If you leave them alone, they could derail your retirement if you don't pay attention to them ahead of time. So in this video, I'm going to break down exactly what RMDs are, required minimum distributions, when you need to take them, and how to reduce taxes you're going to pay legally and very efficiently. So let's first start with what is an RMD, required minimum distribution. That's the minimum amount you must withdraw each year from traditional retirement accounts. So it applies to traditional IRAs, SEP IRAs, simple IRAs, and also employer-sponsored 401k, 403b, etc., as long as you're not still working and contributing to those. Roth IRAs, during your lifetime anyway, are exempt from any kind of RMD, and it's not optional once you hit the age that your RMDs are supposed to happen. The RMD rules under the Secure Act 2.0 are such that when you turn 73, you need to take your first RMD. So if you turn 73 in 2025, you need to take your first RMD by April 1st of 2026. And then subsequent RMDs are due by December 31st each year. If you choose not to take your first RMD in the year in which you turn 73, you can double it up before April of the next year, but then you got 2 years of RMDs to worry about on taxable income. What are the risks of not taking your RMD? Well, there's a penalty. It used to be 50% of the amount that you should have taken. Now that's dropped down to 25% of the shortfall, and that's reduced to just 10% if you get it corrected, the mistake corrected within 2 years. Penalties can erase all the tax savings that you hope to keep from filing that IRS Form 5329, which is needed to report the fact that you missed or were late on your RMD. RMDs have a little bit different calculation that goes with them. You take the account balance on December 31st of the prior year and then divide by your IRS life expectancy factor, which is really just a published table that you can find, and they're the uniform lifetime tables that you can easily do an internet search and find that. If your spouse is more than 10 years younger, then it's a little different calculation. It's a pretty simple calculation. You take the balance December 31st, you look up the factor on the unified table, you do the simple calculation, and you're good to go. One of the things that we've done is we've developed a new RMD calculator tool that there's a lot of RMD calculator tools out there, but what our team did is we put together a calculator tool that then projected what your RMDs are going to be over the rest of your lifetime and showed you what's possible through doing a Roth conversion based on 12 or 1,300 clients that we've done this for. We've used their results and we've loaded them into the calculator tool so that based on your age and balances, we can give you some idea of what's possible to save by doing aggressive Roth conversions. So the impact that the RMD is going to have on you that causes the problem is it counts as ordinary income, and that could increase your tax bracket. That could jump you to another tax bracket for that income. It could cause you to have IRMA surcharges for Medicare purposes. It could cause your Social Security to be taxed greater, and it may cause unintended capital gains stacking, which is a little bit different. It can also disrupt your ACA subsidies for early retirees that aren't on Medicare yet. So there's just a few ways to reduce the tax impact of RMDs. Roth conversions before they begin is optimal. You can use qualified charitable distributions. So you have to be 70 and a half or older, but up to $100,000 a year can be used, and that's indexed for inflation. And you use that to make a contribution directly to a charity of your choice, but it has to go from the IRA custodian to the charity to count. You can't take it as a distribution and then write a check. And if you do it that way, it's excluded from your income. So consider those strategic withdrawals before RMD age to really get that taken care of and move the balance down so it doesn't create all the others, and coordinate it with your Social Security and the timing of your Medicare. The best thing I can tell you is that really there's a lot of opportunity for you to do multi-year tax planning, and there's some really huge long-term savings. If you're an IRA millionaire and you're not using significant amounts of money from your IRA for living expenses, it's a no-brainer to do really aggressive Roth conversions. Some of the key points that I would just want to remind you of is that RMDs are a thing and you have to do them. If you don't, there's a penalty. It's an easy calculation. You just got to go to the tables, but you got to get the money withdrawn before then. The problem that RMDs cause is it causes balances continue to grow over time. And especially if you have a larger IRA balance, it ends up causing all kinds of different things to happen. You can get ahead of that with early planning. So I would suggest that you click on the button on this page someplace, go out, look at our new RMD calculator tool, and it'll give you some idea of what is possible to save if you get the Roth conversions done correctly.